Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today in this final segment. If you missed the first couple, we talked a lot about some of the debate going on about what exactly is a fee-only advisor, and I highlighted some information that was printed in the Wall Street Journal back on September 20th about a study they did. It's some really good information. If you missed it, head on over to our website, dlblain.com. There you'll find archived copies of the shows, and you can catch up there. I moved on in the last segment to talk about private equity and venture capital. We see people, from time to time, especially a lot of people that work in the tech and biotech arenas, our clients, and they work in these industries and they see these massive amounts of money being made, and Google and Apple and Microsoft and biotech firms and things like that. And so they have a lot of questions about private equity and venture capital because, of course, a lot of those firms were started, or maybe not started, but at least somewhere along the way was investment by those type of firms. And, they look at the public markets and they look at, the volatility and the average return, although the stock market's been doing very well. But a couple things. Number one, we don't have the data that we have for public equity. So when you're analyzing private equity and venture capital, the data is not as high quality as we have for private or for public equity. So that's one thing to keep in mind. Whenever you're looking at return numbers, you've got to be somewhat skeptical, especially the survivor bias. And trust me, I know I have invested over the years in different private equity and venture capital deals. The majority of venture capital, and the distinction really, venture capital tends to be, early stage startup type companies. And the majority of those companies and the majority of that investment goes to zero. It's worthless. Well, let me repeat that. The majority of venture capital investing goes to zero and becomes worthless. So if you're worried about a 10 or 20% decline in your portfolio, a well-diversified portfolio, because of 2008 or something like that, and you're asking me about venture capital when the majority of those investments are worth nothing, it's just not an appropriate investment for most people. So private equity typically has the distinction of private equity usually is invested in a later stage. Maybe they come in for a later stage investment to take that company that's already growing and off the ground to the next level. A lot of the private equity I've been involved in is what's called middle market buyout, is you have a company that's successful and the owners are ready to retire, and there's nobody to sell their company to. And that's where private equity comes in, is they buy them out and give the owner a liquidity event. So anyway, so going back, we look at, there was some 20-year data that ended in 2005. So looking at the period 1985 to 2005, we saw that various private equity strategies, venture capital private equity strategies, returned very well the 20 years ending 2005. And if you think back, there was the tech boom in there, just a very positive time frame. And so we saw that we saw a lot of money moving into that. If we fast forward from 2005, the end of 2012, we see that the returns are actually below that of the public equity markets. And even looking at the 20-year period when they appeared to outperform, if you adjust the returns for the higher risk, the investment concentration, the absence of liquidity, a lot of these things you have to lock up your money for 7 to 10 years. The absence of transparency and all those type of things, that the risk-adjusted return, even in the 20-year period where they appeared to outperform, that could be kind of called into question. If you also take into account the fact that the bias against the funds that went out of business, some fund that's going out of business, it's very hard to get the data out of them to report that they were going out of business. And then certainly since 2005, we see the absolute returns of private equity and venture capital as a complete asset class have actually been below that of the public equity markets if you're comparing it to the small cap arena. This study that I'm looking at from a company called Venture Economics, we see that the majority of funds, 62%, failed to exceed the return of the Russell 2000 on an absolute basis on a non-risk adjusted. When you risk adjust it, you see that virtually almost all of them underperformed, just simply investing in the Russell 2000 index. So our advice, private equity venture capital, stay away from it. There are a few people, there's 350 million people in America, of course billions around the world, and there are a few that I would consider able to navigate the private equity and venture capital space adequately. Kind of along with that, we're also getting a lot of questions, say, about market timing. You know, people seem to, after 2008, there were a few advisors and people that were able to call the crash. We were able to do very good for our clients throughout that period, but frankly, a lot of it, we would attribute some of it to luck, and don't anticipate, you know, that we have any knowledge over anyone else. And people that claim that they do are either have been lucky or delusional. In fact, we see there's a website called CXO Advisory Group that I subscribe to, and these people do a lot of quantitative data, a lot of quantitative studies, and they just came out with a new study of roughly 200 investment advisors that claim to, you know, do some sort of market timing, and they vary their equity exposure between, you know, 200%, you know, they actually leverage to 200% shorting the market. And what they found was that the returns were pretty much random, that there was no, about 50% outperformed, 50% underperformed. And of course, in the next time period, the 50% that outperformed will probably underperform the next time. There's just no statistical evidence that managers can consistently and reliably outperform the market. But it is this sort of Goldilocks scenario that people are always searching for, that manager that has the magic formula. And I just warn you against people that claim that they have some sort of magic formula to time the investment markets. Well, that's all the time we have for today. I hope you've enjoyed it. I sure did. We'll be back again same time next week with another great show. I hope you will join us.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.